Your money won't exist in its current form in 5 years. That's not my opinion. That's what financial experts and central banking officials are increasingly suggesting as digital currencies transform our financial system at lightning speed. Today I'm going to show you the 3 major shifts happening right now that are making cash obsolete, why this matters especially for young women building financial independence, and exactly what you need to do to not just survive, but thrive in this new money landscape. If you've been putting off learning about digital currencies or wondering why inflation feels worse than reported, this video will connect all the dots. Why? The money revolution is already happening. Did you know your relationship with money is about to undergo its biggest change in generations? Think about it. That $20 bill sitting in your wallet is becoming a relic faster than most of us realize. This isn't some far-off tech prediction. It's happening right now, silently transforming how we interact with money every single day. Take a look around. When was the last time you actually needed cash? Maybe that one coffee shop that's cash only, or splitting the bill at dinner with friends. But even these holdouts are disappearing. In Sweden, cash transactions now make up less than 1% of all payments. The UK isn't far behind, with cash use dropping by over 60% in just the last decade. Even in the US, nearly 40% of Americans report going a full week without using a single bill or coin. This shift is happening at different speeds across age groups, but the direction is unmistakable. While your parents might still keep cash on hand, just in case, your generation is leading the charge toward digital payments. Mobile payment apps, contactless cards, and online banking aren't just conveniences anymore. They're becoming the only way to pay. Here's the thing. This change isn't just about convenience. It's about control over your financial future, and it affects young women in particular ways that aren't getting enough attention. The existing financial gender gaps, like women earning less, investing less, and having less financial confidence, create real vulnerabilities during major money transitions like this one. Think about your daily life. Have you noticed fewer ATMs in your neighborhood? Banks closing their physical branches? Stores putting up card-preferred signs? These aren't isolated changes. They're connected pieces of a massive shift in our financial infrastructure. The systems that support physical cash are being dismantled right before our eyes, while digital alternatives become the default. And this isn't just happening in tech-forward cities. Rural communities, small towns, and urban neighborhoods are all experiencing this transformation, though not always with the same resources to adapt. The cash ecosystem, from armored trucks to bank tellers to cash registers, is becoming more expensive to maintain as fewer people use it, creating a cycle that accelerates cash's decline. What makes this particularly important for women is how it intersects with existing financial challenges. Women are more likely to work in informal cash economies, have interrupted career paths that affect credit scores, and report less confidence with financial technology. As cash disappears, these gaps could easily widen without intentional preparation. The urgency here can't be overstated. This isn't a change you can react to once it's complete. By then, those who haven't adapted will face serious obstacles. Financial systems don't typically slow down to make sure everyone's caught up. Instead, they evolve to serve those already comfortable with the new normal. Why might your wallet be completely empty within 5 years? Because every piece of the cash infrastructure is being reimagined right now. Banks are closing physical locations and investing billions in digital platforms. Governments are exploring digital currencies that could replace physical cash entirely. Payment companies are creating ecosystems that make cash obsolete. Retailers are designing stores without cash registers. All of these changes are happening not because someone decided cash should go away, but because the economics of cash no longer make sense in a digital world. It's expensive to print, transport, secure, and process. Digital alternatives are simply cheaper, faster, and more profitable for the companies that handle your money. The invisible hand, central banks preparing for cash's end. While companies are naturally moving away from cash for profit reasons, behind the scenes, central banks worldwide are quietly developing their own digital replacements. These aren't just convenient payment apps. They're entirely new forms of money that could fundamentally transform how you interact with every dollar you earn, save, and spend. Central Bank Digital Currencies, or CBDCs, represent the government's answer to the decline of physical cash. Unlike the money in your bank app, which is still managed by private banks, CBDCs would be direct liabilities of central banks themselves. This might sound like a technical distinction, but it completely reshapes the relationship between you and your money. Here's what makes this development so significant. Unlike cash, which provides a level of privacy and anonymity in transactions, CBDCs create a digital trail that could potentially track every purchase you make. Financial experts have raised serious concerns about this unprecedented visibility. When you hand over a $20 bill for coffee, nobody's recording that transaction. With CBDCs, that same purchase could be permanently linked to your digital identity. The global race to develop these currencies is already well underway, though you rarely hear about it on the evening news. China is leading the charge with extensive testing of its digital yuan across multiple cities. The European Central Bank is still in the exploratory phase for their digital euro, examining implementation methods and potential impacts. Meanwhile, in the United States, the Federal Reserve's FedNow system is set to launch in 2023, representing a significant step toward a new digital payment infrastructure. These developments aren't happening at random. There's a coordinated global shift occurring as central banks position themselves for a future where physical cash plays a minimal role in daily transactions. The technical architecture of these new currencies differs significantly from what you're used to with regular digital banking. Traditional digital payments still rely on commercial banks as intermediaries between you and the central bank. CBDCs would remove this middle layer, creating a direct financial relationship between individuals and government institutions. This fundamental difference could completely reshape the banking landscape as we know it. Commercial banks might need to reinvent their business models if they're no longer the primary managers of the money supply. The implications for how you'll bank, borrow, and save in the future are enormous. The timeline for implementation varies significantly by country. While some nations are still years away from full CBDC deployment, others are rapidly moving through testing phases. What's concerning is how little public discussion surrounds these massive changes. Most people have no idea their relationship with money could be completely transformed within just a few years. There are legitimate benefits to this transition. Digital currencies could make transactions more efficient and potentially reduce certain types of financial crime. Cross-border payments might become faster and cheaper. Government benefits could be distributed more directly without intermediaries taking a cut. But these benefits come with significant trade-offs. Privacy advocates warn that CBDCs could enable unprecedented financial surveillance. Every purchase you make could potentially be visible to government authorities in ways cash never allowed. For vulnerable populations who rely on cash, particularly those without reliable internet access or technological comfort, the transition could create new barriers to financial participation. Financial experts suggest the balance between benefits and drawbacks remains uncertain. While CBDCs could streamline many aspects of our financial lives, they may also exacerbate existing inequalities if not designed with inclusivity in mind. The efficiency gains must be weighed against the fundamental changes to privacy and financial autonomy. What? The cryptocurrency revolution you can't ignore. While governments develop their centralized digital currencies, another revolution is happening entirely outside their control. A world where women own less than half the cryptocurrency that men do, despite its potential to create more financial freedom than traditional banking ever could. This gender gap isn't just an interesting statistic. It represents a potential missed opportunity for financial advancement that's growing more significant by the day. Remember when cryptocurrency was dismissed as an internet fad for tech enthusiasts? Those days are long gone. The landscape has transformed dramatically as cryptocurrencies have evolved from fringe investments to mainstream financial tools. What's truly eye-opening is how quickly the institutional attitude has shifted. Major companies like PayPal now allow users to buy, hold, and sell cryptocurrencies directly from their accounts. Even more telling, financial giants like JP Morgan and Goldman Sachs, who once publicly dismissed crypto, have begun offering crypto-related services to their clients. This rapid adoption by financial institutions signals something important. They see value and staying power in this technology. But here's where things get concerning. Despite this growing legitimacy, there's a significant imbalance in who's participating. Only 26% of women own cryptocurrency compared to 43% of men. This gap means women could be missing out on potential wealth-building opportunities in what might be the biggest financial shift of our generation. Let's talk about what makes cryptocurrencies different from the government-backed digital currencies we discussed earlier. Unlike CBDCs, which are centralized and controlled by governments, cryptocurrencies operate on decentralized networks. This means no single entity has complete control over the system, a fundamental difference that creates both opportunities and challenges. The security aspect is particularly noteworthy. Blockchain technology, which underlies most cryptocurrencies, offers enhanced security features compared to traditional banking. The decentralized nature and cryptographic security make it significantly harder for unauthorized parties to alter transaction data or commit fraud. This increased security is one of the key reasons more people are becoming interested in crypto as an alternative to conventional banking. But what does this mean for everyday women? Take Amanda Johnson, for example. She transformed her financial situation by investing in Bitcoin early on, reporting a 400% return on her investment within just a few years. Her story isn't unique. Women-led investment groups focusing on cryptocurrency are emerging, creating supportive communities where women can learn together and build confidence in this new financial space. The adoption rates tell an interesting story about who's embracing this technology. Younger individuals are leading the charge. About 60% of millennials are likely to invest in cryptocurrencies, compared to only 25% of baby boomers. Gen Z is also showing significant interest, with many expressing eagerness to learn about and invest in crypto. This generational divide suggests we're witnessing a fundamental shift in how younger people think about money and investment. Despite growing interest, misconceptions continue to hold many women back from exploring cryptocurrencies. Common beliefs that crypto is too volatile or complex can lead to missed opportunities. Yes, cryptocurrencies can be volatile, but they also offer unique benefits that traditional financial systems don't. Understanding the basics doesn't require a degree in computer science. Just like learning to drive a car doesn't require understanding every component under the hood. What's particularly interesting is how cryptocurrency could potentially address some long-standing issues in traditional finance. Global markets become accessible without expensive intermediaries. Transaction fees can be significantly lower for international transfers. And perhaps most importantly, investment opportunities that were once available only to accredited investors or those with significant capital are becoming accessible to average consumers. The hidden truth about inflation and your savings. For all the talk about investment opportunities, there's a more immediate financial threat most women aren't aware of. That emergency fund sitting in your savings account. It's actually losing approximately 2.7% of its value every year, which means the $10,000 you've carefully saved buys significantly less with each passing month. This isn't just a minor inconvenience. It's a silent wealth drain happening in plain sight. While your account statement might show the same number, or even a tiny increase from interest, the real purchasing power of that money is steadily declining. Think about it. If you bought groceries last year for $100, those same items might cost you $102.70 today. Your money is literally worth less as time passes. The math gets even more concerning when we look at the actual numbers. If you have $10,000 in a typical savings account earning that pitiful national average interest rate of 0.05%, you're not just failing to grow your money. You're actively losing around $270 in purchasing power in just 1 year. Stretch that to 3 years, and you've lost about $811. Keep it there for 5 years? That's approximately $1,400 gone, even though your account balance might show a slight increase. This problem creates a painful financial dilemma. We're constantly told to keep emergency funds and savings accounts for safety and liquidity, but that safe choice now comes with a guaranteed loss. The traditional financial advice most of us grew up with simply doesn't work in today's economic environment. Keeping substantial cash reserves might feel secure, but it's actually the opposite. It's ensuring your financial foundation gradually crumbles. What makes this situation particularly troubling for young women is the tendency to hold more cash compared to their male counterparts. This isn't about making different spending choices. It's about how we've been socialized to think about financial security. Many women perceive cash as safe and investments as risky, when in reality, holding too much cash over time is guaranteed to reduce your wealth. This cash preference means women are disproportionately affected by inflation's erosive effects, creating yet another hurdle in the already challenging path to financial equality. When your carefully saved dollars buy less each year, the wealth gap widens even for those doing all the right things according to conventional wisdom. It helps to understand that we're not facing something unprecedented. Throughout history, major transitions in currency systems have often triggered significant inflationary periods. When nations moved away from the gold standard to fiat currency, for instance, similar challenges emerged as people navigated new financial realities. The difference today is that we have more options available to protect our purchasing power. This is where digital currencies enter the conversation in a meaningful way. Both cryptocurrencies and the emerging central bank digital currencies offer potential alternatives to traditional cash holdings during inflationary periods. While they come with their own risks and considerations, they represent possible solutions to the problem of maintaining purchasing power in a changing economy. The connection between inflation and digital currency adoption isn't just theoretical, it's practical. As more people realize their savings are shrinking despite doing everything right, they naturally seek alternatives that might better preserve value. This practical need, more than technological fascination, is driving many everyday people toward digital currency options. Think about the basic human desire to protect what you've worked for. If you discovered that storing food in your refrigerator caused it to slowly disappear, you'd look for a better storage solution. The same principle applies to your money. As inflation continues to erode cash value, alternatives that offer better protection become increasingly attractive, accelerating the move away from physical currency. Why young women face unique challenges in the cashless transition. As we search for better ways to protect our money, there's an uncomfortable truth we need to address. The financial playing field isn't level to begin with. The rapid shift to digital payments might sound exciting, but the reality is that this transition affects us differently depending on our gender, income, and access to technology. Did you know women earn just 82 cents for every dollar men make? This pay gap is just the beginning of a much deeper financial divide. When your starting resources are already limited, adapting to major financial changes becomes that much harder. This isn't just about having less money. It's about having fewer opportunities to build financial confidence and experience. The confidence gap in financial technology is particularly striking. Only 38% of women feel comfortable using financial technology, compared to 62% of men. Think about what that means in practical terms. When your local bank branch closes and you're expected to manage everything through an app, that transition is simply more stressful if you already feel uncertain about using financial technology. This matters even more when we look at how women participate in the economy. Many women work in what economists call the informal economy, jobs that operate outside traditional employment structures. Think of childcare providers, market vendors, or housekeepers who are often paid in cash. In many developing countries, women make up a huge portion of this cash-dependent workforce. When societies go cashless, these women don't just need to learn new technology. They may need to completely restructure how they receive payment for their work. The security concerns are real, too. Women experience financial fraud and identity theft at higher rates than men. When every transaction leaves a digital footprint, privacy becomes a real concern. Imagine being in a situation where you need to make private purchases without someone tracking your spending. In a fully digital system, this becomes much more difficult. What's particularly frustrating is how financial apps and services are designed. Most financial products are created with a one-size-fits-all approach that doesn't consider women's unique financial behaviors. It's like trying to use tools that weren't made with you in mind. They work, but they never feel quite right. The interfaces, the language used, even the examples provided often center on traditionally male financial concerns and behaviors. We can see real-world examples of how this plays out by looking at Sweden's rapid transition to digital payments. When Sweden quickly embraced cashless payments, it was women in lower income brackets who struggled the most. This wasn't just about technology adoption. It was about a financial system that wasn't designed with women's realities in mind. Many women found themselves suddenly cut off from familiar financial systems they had relied on for years. This isn't just an issue in developed economies. In parts of Africa where mobile money has taken off, the gender gap in mobile phone ownership has created new financial divides. Women who don't own phones or lack reliable internet access can find themselves increasingly excluded from economic opportunities. Think about all these factors together: lower starting incomes, less confidence with financial technology, higher representation in cash-based work, greater security concerns, and financial products that weren't designed with women in mind. These challenges don't exist in isolation. They compound each other, creating significant barriers as our financial systems transform. How? The financial literacy revolution you need. The barriers facing women in the cashless transition might seem overwhelming, but there's a powerful tool that can transform these challenges into opportunities. While our schools teach us algebra and literature, most fail to equip us with what might be the most crucial skill for our future: understanding how money really works in the digital age. Financial literacy isn't just another buzzword. It's becoming the dividing line between those who will thrive and those who will struggle as cash disappears. Think about it. When you understand the financial landscape, you navigate it with confidence rather than fear. But here's the reality. Most of us have been left to figure out the most important financial concepts on our own, especially as women. This knowledge gap feels especially unfair when the world of money is transforming so rapidly around us. Let's talk about what you actually need to know to thrive in a cashless world. Understanding digital security goes beyond just having strong passwords. It means comprehending how your financial data moves between systems and where vulnerabilities might exist. Knowledge of cryptocurrency fundamentals isn't just for tech enthusiasts anymore. It's becoming essential as these alternatives gain mainstream acceptance. And as governments roll out central bank digital currencies, understanding what these mean for your privacy and purchasing power will be crucial. Monetary policy might sound like something only economists need to worry about, but it directly impacts your daily life. When you understand how interest rates affect your loans, how inflation erodes your savings, and how economic policies influence job markets, you make smarter decisions about when to save, when to invest, and when to spend. This knowledge becomes even more valuable during economic uncertainty and as digital currencies reshape our financial system. The benefits of building this knowledge aren't theoretical. They're practical and life-changing. Women who participate in financial education programs consistently report higher savings rates. Those with stronger financial literacy are more likely to invest in stocks and other growth assets, which leads to significant wealth accumulation over time. Most importantly, financial knowledge builds confidence. Confidence to negotiate, to plan for the future, and to make decisions that align with your values. The good news: resources specifically designed for women's financial education are becoming more accessible every day. These aren't your typical dry financial textbooks. They're practical, supportive programs that address the unique challenges women face. They focus on building both skills and confidence, often in formats that fit into busy schedules. What makes these women-focused resources different is their emphasis on community. Learning about money doesn't have to be a solo journey. Supportive communities and groups create spaces where women can learn together, share experiences, and encourage each other through the process. These collective learning environments help overcome the intimidation factor that often surrounds financial topics. These communities recognize that financial education isn't just about memorizing terms or learning formulas. It's about changing how you relate to money and building confidence in your financial decisions. When you're surrounded by others on similar journeys, challenges become less overwhelming and progress becomes more sustainable. So what are the 3 essential financial skills you need before cash disappears? First, understanding digital security. Knowing how to protect your financial information in an increasingly vulnerable digital landscape. Second, recognizing how monetary policy affects your money, because the big economic picture directly impacts your personal finances. And third, mastering digital financial tools, because the platforms we use. Digital security, protecting what you can't hold. Digital security isn't just a technical skill, it's becoming the foundation of financial survival. When your life savings are essentially just numbers in a database, accessible from anywhere in the world, the security practices that protected previous generations simply don't apply anymore. What's particularly concerning is that women are being specifically targeted by digital financial fraudsters who exploit trust and social connections, despite many lacking the security knowledge needed to protect their digital assets. Let's talk about what you're actually up against in this new financial landscape. Phishing attacks are one of the most common threats. These are when someone pretends to be your bank or another trusted organization to trick you into sharing your personal information. They might send an email that looks exactly like it's from your bank, asking you to verify your account details. Then there's malware, harmful software that can secretly install itself on your devices and track everything you type, including your passwords. Account takeovers happen when someone gains access to one of your accounts and then uses that information to break into others. The scariest part? These attacks are becoming more sophisticated every day. Fraudsters are now combining real information about you that might have been exposed in data breaches with fake details to create synthetic identities that can be incredibly difficult to detect. But here's the good news. You don't need to be a tech expert to protect yourself. Let's start with a simple security audit you can do right now. First, make a list of all your financial accounts, banks, credit cards, investment apps, payment services like Venmo or PayPal. For each one, ask yourself, do I have a unique password? Is two-factor authentication enabled? Have I updated the contact information recently? Have I checked the account activity in the last month? This audit will likely reveal some gaps in your security setup. That's okay, most people have them. The key is addressing them systematically, starting with the most important accounts. Password management is probably the biggest challenge for most of us. We know we should use different, complex passwords for every account, but how do you possibly remember them all? This is where password managers come in. They're like secure digital vaults that generate and store complex passwords for you. You only need to remember one master password to access all your others. Popular options like LastPass, 1Password, and Bitwarden make this process simple, even if you're not particularly tech-savvy. Next, let's talk about two-factor authentication, or 2FA as it's often called. This is absolutely non-negotiable for your financial accounts. It adds an extra layer of protection by requiring not just your password, but also a second verification method, usually a code sent to your phone or generated by an authentication app. Even if someone somehow gets your password, they still can't access your account without that second factor. It's like having both a key and a fingerprint scanner for your front door instead of just a key. Women in particular need to be aware of certain warning signs that might indicate a scam. Be suspicious of unsolicited messages asking for personal information. Legitimate companies almost never reach out this way. Watch out for offers that seem too good to be true or create a sense of urgency. Be careful with requests for money transfers, especially if they're coming from someone you've only met online. And be wary of investment opportunities or charities that heavily play on emotional appeals. Scammers know that women are often more responsive to appeals that focus on helping others. Some other best practices that anyone can implement include regularly updating your devices and apps. Those updates often contain security fixes, being careful about the information you share on social media, which can be used to answer security questions, and setting up alerts for all activity on your financial accounts so you know immediately if something suspicious happens. Building your digital money framework. What would happen if you woke up tomorrow and cash simply wasn't an option anymore? While securing your accounts is essential, having a comprehensive digital money framework might be even more important. As we approach a world where 178 million Americans will use mobile payments by 2025. Oh, wait a minute, that's right now, so it's time to think beyond just having a few payment apps. Let's be honest, most of us aren't structured for a truly cashless existence. The average person uses just 3 to 4 financial apps today, but that narrow approach creates a single point of failure that could leave you financially stranded. What you need instead is a personal digital money framework, an interconnected system of financial tools that gives you multiple ways to access, move, and protect your money regardless of what happens. Think about your current setup. If your primary payment method suddenly stopped working, how many backup options do you have? If your phone died or you lost your wallet, could you still buy groceries? These aren't just hypothetical questions anymore. They're becoming everyday realities as our financial systems transform. The foundation of a solid digital money framework starts with diversification across platforms. This means having multiple digital wallets that can function independently of each other. Consider setting up separate payment apps like Venmo, Cash App, and PayPal, each connected to different funding sources. This redundancy ensures you're never completely cut off from your money if one system experiences issues. Next, look at the banking layer of your framework. Beyond your primary checking account, Consider opening an account with an online-only bank that offers different features and potentially better interest rates. The introduction of FedNow, a real-time payment rail from the Federal Reserve, is creating new possibilities for bank-to-bank transfers that happen instantly. Make sure your banking relationships take advantage of these innovations. But building a framework isn't just about having multiple accounts. It's about how they work together. Create a map of your money flow, showing how funds can move between your accounts in different scenarios, which transfers are instant, which take days. Having this mental model helps you navigate disruptions with confidence. When selecting financial apps for your framework, prioritize security over convenience. Look beyond flashy interfaces and focus on robust identity verification features that protect against fraud. The best apps offer multiple security layers and clear processes for resolving issues if something goes wrong. Tracking spending becomes more challenging when you can't physically see your cash disappearing from your wallet. That's why budgeting apps that categorize expenses across all your accounts are vital components of your framework. They provide the visibility you need to maintain financial awareness in a digital environment. Remember that a truly resilient framework also includes some physical backup strategies. While going fully digital is the trend, keeping a small emergency cash reserve in a secure location provides insurance against system-wide technological failures. Some women I work with also incorporate tangible assets like precious metals as part of their comprehensive protection strategy. Your framework should also address the question of financial legacy. Digital assets can be harder for loved ones to access if something happens to you. Include a secure but accessible record of your digital financial life, protected by your password manager, but available to trusted individuals if needed. What specific tools should you start with right now? First, establish a robust password manager that uses encryption to protect your financial credentials. Next, set up a multi-currency digital wallet that can handle various payment types, including emerging options. Finally, implement automated savings tools that move money strategically to beat inflation without requiring constant attention. Reimagining daily life in a cashless world. Now that you've got your digital money tools in place, let's talk about what actually using them looks like day to day. Did you know that in Sweden, even homeless newspaper vendors now accept mobile payments? This isn't just about new apps. It's about reimagining the entire rhythm of your daily financial interactions. Imagine waking up tomorrow and starting your day completely cashless. Your morning coffee purchase happens with a simple tap of your phone or smartwatch. The barista doesn't need to handle cash, count change, or even touch your payment method. In fact, in many Swedish cafes, this is already standard practice. The transaction is seamless, contactless, and takes just seconds. But the change goes deeper than convenience. When you meet friends for lunch, the awkward moment of splitting the bill vanishes. Instead of calculating who owes what and scrambling for exact change, your group uses a shared payment app where everyone can instantly transfer their portion. The social dynamics around money shift. No more, I'll get you next time, or keeping mental tabs of who owes what. The future of person-to-person payments is evolving far beyond today's apps. By 2025, nearly 178 million Americans will be making peer-to-peer payments directly from their bank accounts. These systems are becoming more intuitive, requiring fewer steps and offering enhanced security features. Imagine simply mentioning you need to pay someone while talking to your phone's assistant, and the transaction happens automatically after voice verification. Looking at countries that are already living this reality gives us fascinating glimpses of our future. In China's major cities, the transformation has been remarkable, with mobile payment platforms handling everything from street food purchases to utility bills. The integration goes beyond just payments. Your transportation pass, loyalty programs, and even health information all connect through the same ecosystem, creating a unified experience that makes traditional wallets seem clunky and outdated. But this transformation isn't without challenges. What happens to those without smartphones or reliable internet access? This digital divide presents a serious concern as cashless systems become dominant. Solutions must include increasing digital literacy programs and ensuring technology access for underserved populations. Countries further along in the cashless transition are actively addressing these issues through community tech centers and simplified versions of payment tools designed for older adults and those with limited technical experience. The The daily experience of managing your finances also transforms in unexpected ways. Without physical cash to count, your budgeting becomes more automated and precise. Modern fintech apps can categorize every purchase, alert you to unusual spending patterns, and provide real-time insights about your habits. Many women report this visibility makes them feel more in control of their finances, as the guesswork disappears from tracking where money goes. Record-keeping simplifies dramatically too. No more saving receipts in shoeboxes or manually entering expenses. Every transaction creates a digital record that can be automatically organized for tax purposes or personal analysis. This automation frees up mental space previously dedicated to financial administration. For businesses, especially small women-owned enterprises, the benefits extend to reduced cash handling costs and improved security. Digital payments typically include built-in fraud protection features that create peace of mind for both the seller and buyer. This security layer represents a significant improvement over cash transactions where disputes could become complicated without paper trails. The rhythm of your daily financial life in this cashless world feels different, more fluid, more connected, and in many ways, more intelligent. Your financial apps learn your patterns and preferences, making suggestions before you even realize you need them. Your smart refrigerator might notice you're low on essentials and add them to your digital shopping cart for approval, with payment and delivery happening automatically once confirmed. The new banking relationship. What if your bank wasn't a place you visit, but an intelligent service that follows you everywhere, anticipating your needs before you even recognize them yourself? The traditional banking relationship, where you visit a branch to deposit checks or speak with a loan officer, is rapidly transforming into something far more integrated with your daily life. This evolution isn't just about convenience. It's reshaping the fundamental dynamics between you and your financial institutions. While this shift offers exciting new possibilities, it also creates potential vulnerabilities if you're not prepared to navigate the changing landscape. Remember how banking used to be a one-stop shop experience? You'd open an account at your local branch and get everything from your checking account to your mortgage in one place. That model is breaking apart. Banking services are unbundling, with specialized providers offering targeted solutions for specific needs. Instead of relying on a single institution for all your financial needs, you're gaining the freedom to select specialized services that work best for you. This unbundling is happening alongside the rise of neobanks, digital-first financial providers that operate without physical branches. These tech-forward companies are experiencing remarkable growth, attracting customers who prefer managing their finances entirely online. Their streamlined operations often translate to fewer fees and more competitive rates than traditional banks. If you're comfortable with technology, these options can provide significant advantages, though they lack the personal touch of face-to-face interactions. The fintech explosion is creating a more fragmented financial ecosystem. Most users now juggle 3 to 4 different financial apps, each serving a specific purpose. One might handle your daily spending, another your investments, and a third your savings goals. This trend is expected to continue, requiring you to become more strategic about how you organize your financial tools. Something else is changing too. The currency of your banking relationship is shifting from cash to data. Financial institutions are increasingly leveraging your information to create personalized experiences. When your bank notices you frequently order takeout on Fridays, it might partner with local restaurants to offer you special deals. This data-driven approach allows for more tailored financial guidance, but also raises important questions about privacy and control over your personal information. As banking becomes more digital, customer service expectations are evolving dramatically. The days of being satisfied with basic online banking are over. Today, you likely expect seamless integration between your various financial apps. Your budgeting tool should talk to your investment platform, which should connect with your payment apps. This interconnected ecosystem represents a fundamental shift in how you interact with financial services. For women, this transformation presents both opportunities and challenges. Financial institutions are finally recognizing the unique needs of women customers and developing services that address specific concerns like lower income levels and greater financial insecurity. Some banks now offer programs focused on improving financial literacy specifically for women, acknowledging that traditional financial education often hasn't adequately served female customers. When evaluating where to place your financial trust, look beyond flashy apps and marketing. Ask critical questions. Does this institution offer educational resources? Do they provide tools to build financial confidence? Are their customer service representatives responsive to your specific concerns? The best financial partner will not only safeguard your money, but also empower your financial journey. Looking just 3 years ahead, your banking relationship will likely transform from transaction-based interactions to advisory-focused partnerships. AI-powered systems will analyze your spending habits, income patterns, and financial goals to provide increasingly sophisticated personalized guidance. The number of physical touchpoints will continue to decrease, replaced by more intelligent digital interactions that anticipate your needs. Imagine receiving a notification that automatically suggests shifting funds to a higher interest account based on your cash flow patterns, or getting personalized recommendations for financial products that specifically match your lifestyle and goals. This level of customization is where banking is headed, less about where you store your money and more about how your financial services integrate with and enhance your life. Diversification beyond cash, the new safety net. While your banking relationships are evolving, an even more fundamental shift is happening with money itself. Did you know that keeping all your savings in cash, whether physical or digital, might be one of the riskiest financial decisions you're making right now? The safety net that protected previous generations simply doesn't work the same way anymore. Think about it. A truly resilient financial strategy needs to spread across different types of assets, not just different bank accounts. This isn't the standard diversification advice you've probably heard about putting money in various stocks and bonds. I'm talking about something more fundamental, protecting yourself against changes in the nature of currency itself. Let's break down what real diversification looks like in today's changing world. Beyond cash, you've got several asset classes that each provide different types of protection. Stocks give you ownership in businesses that can adjust their prices during inflation. Bonds provide income and stability. Real estate offers both a useful asset and potential appreciation. And newer alternatives like peer-to-peer lending platforms allow you to support others while earning returns that often outpace traditional savings. But how much should you put where? While there's no one-size-fits-all answer, many financial advisors suggest a starting point of about 60% in equities, stocks and stock funds, 30% in fixed income, bonds, and 10% in alternatives like real estate or digital assets. The key is adjusting these percentages based on your personal risk tolerance, timeline, and financial goals. Here's something interesting. Research shows that women often excel at certain types of diversification strategies, particularly when it comes to socially responsible investing. Many women naturally gravitate toward investments that align with their values and focus on long-term sustainability rather than short-term gains. This approach, considering the environmental, social, and governance (ESG) impact of investments, has proven to be both financially sound and personally satisfying. But I get it, diversification can feel overwhelming when you're just starting out. The good news is that there are plenty of entry-level options that don't require a huge investment. For stocks, low-cost index funds let you own tiny pieces of hundreds of companies with just a few dollars. Robo-advisors can automatically manage a diversified portfolio for you with minimal fees. And micro-investing platforms allow you to start with literally spare change from your everyday purchases. Let's address some common fears about diversification. Many women worry about the complexity of managing multiple asset types, but education is the answer here. Start with one new asset class at a time, learn the basics, and then expand. Others fear losing money in volatile markets, but historical evidence shows that diversified portfolios tend to weather economic storms better than concentrated investments. Remember, you don't need to become a financial expert overnight. Small steps matter. Maybe you start by putting just 5% of your savings into a low-cost index fund, then gradually increase that percentage as your comfort grows. Or perhaps you explore a micro-real estate investment through a platform that allows fractional ownership. The digital shift we're experiencing isn't just changing how we pay for things, it's changing what money means. Traditional advice about simply saving cash doesn't account for this fundamental transformation. That's why diversification isn't just a good strategy, it's becoming essential for financial survival. Multiple income streams, financial security in the digital age. The security of having one steady paycheck hitting your bank account might feel like the safe path. But in today's rapidly changing economy, it's becoming the financial equivalent of putting all your eggs in one increasingly fragile basket. What would happen to your financial life tomorrow if your paycheck suddenly stopped? In a world where job security is becoming as outdated as physical cash, relying on a single source of income might be the riskiest financial decision you're making. Think about the most financially resilient women you know. Chances are, they're not just depending on one job to pay the bills. According to recent research, 55% of consumers are now using Fintech apps to help them navigate economic challenges. These digital tools aren't just changing how we manage money, they're transforming how we make it. The good news: creating multiple income streams doesn't mean working 3 different full-time jobs. Instead, it's about strategically developing different categories of income that work together. Think of it like this. Your primary job might be your active income base, while a side business, investments, or digital content could provide passive income that makes money even when you're sleeping. Digital platforms have completely changed the game when it comes to income opportunities. The rise of peer-to-peer payment technologies is creating new financial pathways, with projections showing nearly 178 million Americans will be making mobile P2P payments by 2025. This digital infrastructure makes it easier than ever to monetize skills you already have. Let's talk about what this looks like in real life. Many women are finding success with flexible digital income sources that work around their existing schedules and responsibilities. The research shows a growing trend toward freelancing, e-commerce, and content creation, all areas where women can leverage their existing skills without committing to traditional employment structures. For example, if you're organized and detail-oriented, virtual assistance has become a booming field with minimal startup costs. Got a knack for explaining complex topics? Online tutoring platforms connect you directly with students willing to pay for your knowledge. If you're social media savvy, many small businesses desperately need someone to manage their online presence for just a few hours a week. When evaluating potential income streams, you need a practical framework to help you decide where to invest your limited time. One approach is to plot opportunities on a simple matrix that weighs effort against potential return. The ideal starting point: low effort, high return activities that align with skills you already have. This thoughtful assessment helps you prioritize opportunities rather than chasing every possibility. What's particularly exciting is how the digital economy is creating opportunities that work with women's lives rather than against them. Time management doesn't have to be overwhelming. Setting specific, achievable goals and dedicating even just 5 to 10 hours a week to a side project can lead to significant results over time. The key is consistency rather than intensity. Some of the most successful stories come from women who started very small. One teacher began creating digital lesson plans on weekends, eventually building a 5-figure passive income stream from educational resources that now sell automatically. A marketing professional leveraged her expertise by teaching an online course once, then set it up to enroll new students continuously, creating income that required minimal ongoing maintenance. The beauty of these digital income streams is that they often start as complementary to your main job, but can grow to provide meaningful financial protection. Many began by dedicating just Sunday afternoons to their projects, using productivity tools to maximize their limited time. What makes this approach powerful isn't just the extra money, it's the security of knowing you're not dependent on a single source of income. If your main job disappears tomorrow, you haven't lost everything. If one stream slows down, others can compensate. This diversification weekly financial practice kind of financial resilience that a single beyond building multiple income streams. There's another secret weapon in the financial resilience toolkit that takes just minutes each week. Most people avoid looking at their finances regularly because it triggers anxiety. But what if I told you that this avoidance is actually causing the very stress you're trying to escape? The simple practice I'm about to share has transformed how thousands of people interact with their money. Let's face it, we all want to feel good about our finances, but many of us dread looking at our bank accounts. Studies show that people who spend just 20 minutes a week reviewing their finances report significantly less financial anxiety. This isn't about complex spreadsheets or judgment-filled budgeting sessions. It's about building a financial awareness muscle that helps you thrive in our increasingly digital money world. Think of your weekly money check-in like brushing your teeth. a simple habit that prevents bigger problems down the road. When you take just 20 minutes each week to review what's happening with your money, you create a powerful awareness that naturally guides better decisions throughout the week. Here's what your 20-minute weekly review might look like. First, check your current balances across all accounts to get a complete picture. Next, review your recent transactions, not to judge yourself, but to notice patterns. Then, look ahead at upcoming bills and expenses. Finally, take 5 minutes to reflect on what you've learned and any adjustments you want to make. What makes this practice so powerful is that it builds the exact awareness muscle you need for navigating a cashless world. When your money exists primarily as digital information, your ability to maintain a clear mental picture of your financial situation becomes essential. This weekly practice trains that exact skill in a low-pressure way. The beauty of this approach is how it can be tailored to work for you. Some people prefer using colorful spreadsheets that visualize their progress toward goals. Others love apps that automatically categorize spending and show pretty charts. The right tracking method is simply the one you'll actually use consistently. The key is finding a system that feels motivating rather than discouraging. Let me share a template that's worked for many people starting this practice. Create a simple document with 4 sections. Income review, what came in this week. Expense check, what went out. Savings progress, movement toward goals. And weekly reflection, what you noticed and how you feel. This basic framework can be expanded or simplified based on what matters most to you. I know what you're thinking. I don't have time for one more thing on my to-do list. This is the most common obstacle people mention. The solution: anchor this practice to something you already do regularly. Maybe it's Sunday morning with coffee, Friday afternoon before you log off work, or Monday evening as you plan your week. By attaching it to an existing habit, you're much more likely to follow through. Another challenge many people face is emotional resistance. Looking at finances can bring up feelings of guilt, shame, or anxiety. The fix? Start with curiosity instead of judgment. Notice patterns with the same neutral interest you might have watching wildlife. Oh, interesting. I spent more on takeout this month. I wonder what was happening in my life that week. This curious approach completely transforms the emotional experience. What makes this weekly practice so effective is how it gradually strengthens your financial confidence muscle. Each week, you become slightly more comfortable with your money. You start noticing patterns earlier. You make adjustments sooner. And perhaps most importantly, you develop a healthy relationship with money that serves you well regardless of how the financial system evolves. What if the opportunity landscape for financially savvy people? That healthy relationship with money doesn't just protect you from financial storms. It positions you for unprecedented opportunity. As traditional banking systems continue to exclude millions of Americans, financially savvy people are stepping in to reshape the landscape in ways that benefit everyone. Let's picture 2 possible futures. In one, you're constantly playing catch-up, struggling to understand each new financial tool as it emerges, feeling that familiar knot of anxiety whenever money decisions need to be made. You stick with what feels comfortable rather than what builds wealth, watching opportunities pass by while others seem to effortlessly navigate this new terrain. Now imagine a different path. You've built your financial confidence muscle through consistent practice. You understand both the technology and psychology of money. When new payment platforms emerge, you evaluate them quickly rather than avoiding them. When investment opportunities arise, you can assess them without that paralyzing fear of making a mistake. This version of you isn't just surviving the cashless transition. You're leveraging it to create wealth and impact. The gap between these 2 futures expands dramatically with each passing year. Why? Because financial knowledge compounds just like interest. Small advantages today create massive differences tomorrow. What's particularly exciting is how this financial revolution is creating leadership gaps that people are uniquely positioned to fill. The data shows peer-to-peer payment platforms are becoming normalized, with projections showing 178 million Americans making mobile payments by the end of 2025. This rapid growth means companies need leaders who understand both technology and human behavior, a combination where people often excel. Financial confidence doesn't just change your bank account, it transforms every area of your life. When you're not constantly worried about money, you negotiate more effectively. You make career decisions based on growth rather than immediate security. You build businesses that align with your values instead of just paying the bills. This ripple effect of financial empowerment can't be overstated. We're already seeing examples of people who recognized opportunities during financial transitions. Many have entered the fintech space and taken leadership roles, reshaping the financial landscape to be more inclusive. These people didn't necessarily have traditional finance backgrounds. They simply understood that major transitions create vacuums where new approaches are desperately needed. People bring distinct advantages to this evolving financial environment. Research shows we tend to adopt more collaborative approaches and focus on community-driven financial solutions. These aren't just nice qualities. They're becoming business imperatives as finance becomes more socially connected. The tendency to consider broader impacts beyond profit can lead to more sustainable and successful financial models. The rise of alternative credit scoring methods represents another massive opportunity. Traditional credit scores exclude approximately 49 million Americans, including many people and people from underrepresented groups. Companies developing new ways to measure creditworthiness that don't rely on traditional metrics will capture enormous untapped markets. People who understand both the technical and human sides of this challenge can build solutions that work for previously excluded communities. Experts in the field predict that financial inclusion will evolve positively with more people's leadership. Diverse perspectives naturally lead to more equitable financial systems and products that serve broader audiences. Think about the opportunities in underserved markets where traditional banking has failed to meet the needs of people and marginalized communities. These represent both profit potential and social impact. The fintech landscape will continue evolving, with artificial intelligence playing an increasingly critical role in personal finance management. This presents yet another avenue for people to take control of their financial futures, while potentially designing the very tools that will shape money management for the next generation. The ongoing transformation in how we perceive and use money isn't something to fear. It's an invitation to participate in reinventing the system. People who adapt to these changes will find unexpected leadership opportunities and investment potential in emerging financial sectors. The question isn't whether these opportunities exist, but whether you'll be positioned to recognize and seize them. Your 30-day action plan for financial transformation. Positioning yourself to recognize financial opportunities is one thing, but taking action to embrace them is where real transformation happens. Most of us have heard advice about improving our finances, but let's be honest, that information just sits there collecting digital dust in our bookmarks folder unless we implement it. The question isn't whether you need to adapt to our changing financial landscape, but how quickly you can turn knowledge into practice. What if I told you that the gap between financial stability and anxiety could be bridged in just 30 days of focused effort? Not years, not even months, but a single month of intentional practice. This isn't about getting rich quick. It's about building a foundation that positions you to thrive in our increasingly digital financial world. Let's break down exactly what this 30-day transformation looks like week by week, with specific actions you can implement immediately. Week 1 is all about conducting a thorough security audit and setting up essential accounts. Start by listing every financial account you currently have: banking, credit cards, investment accounts, everything. Then check each one for security features. Are you using the same password across multiple accounts? That stops now. Implement a password manager if you haven't already. Enable two-factor authentication on every single financial account. This simple step drastically reduces your vulnerability to hacking. Finally, update all your contact information to ensure you'll be notified immediately of any suspicious activity. In week 2, focus on building your financial literacy foundation. The good news: you don't need a finance degree to understand how money works in the digital age. Dedicate 20 minutes each day to learning one new financial concept through free online resources. Look for fintech apps that gamify the learning process, making it easier to understand budgeting, saving, and investing. Subscribe to one financial newsletter written specifically for people. Join an online community where you can ask questions without judgment. Remember, financial literacy isn't about memorizing terms. It's about understanding how money flows in your life. Week 3 is when things get exciting. This is where you'll explore diversification strategies and potential income streams. Research different asset classes beyond cash savings. Look into low-cost index funds that give you exposure to the stock market with minimal risk. Consider whether cryptocurrency might have a place in your portfolio, even if it's just a tiny percentage to get comfortable with the technology. Simultaneously, brainstorm 3 to 5 potential additional income streams that align with your skills and interests. Could you monetize a hobby? Offer a service online? The goal isn't to launch a business overnight, but to identify possibilities. By week 4, you'll establish your weekly financial review practice. Set aside a specific time each week, perhaps Sunday afternoon or Monday morning, to review your finances. Create a simple template with 4 sections: income review, expense check, savings progress, and weekly reflection. Track your spending across all accounts and adjust your strategy as needed. This weekly check-in is your opportunity to catch problems early and celebrate progress, no matter how small. The beauty of this 30-day plan is that it builds progressively. Each week builds on the previous one, creating a comprehensive approach to financial management. And the results? By the end of the month, you'll notice increased financial confidence. That nagging anxiety about money will begin to dissipate. You'll have a clearer understanding of where your money goes and how it works for you. Most importantly, you'll have established a routine for ongoing financial management that takes minimal time but yields maximum peace of mind. The future of money is here, your role in the revolution. The financial confidence you've been building goes far beyond your personal financial well-being. What if I told you that people aren't just adapting to the changing financial landscape, they're actively redesigning it? Let's explore the revolution you're actually joining. People's perspectives in financial system design are revealing something remarkable. They consistently highlight inclusivity and accessibility, which leads to more comprehensive solutions for everyone. This isn't just a nice-to-have feature. It's transforming how financial products work at their core. When people step into financial leadership roles, they bring unique insights that traditional banking simply missed for decades. Look at what's happening in Fintech right now. People-led financial innovations are making a significant impact, creating solutions that address specific challenges people face. These aren't niche products. They're demonstrating that when you design for previously overlooked needs, you often create better systems for everyone. But here's what makes this moment truly special. You're not on this journey alone. Communities and resources specifically for people on financial journeys are expanding rapidly. Organizations like Elvest and SheEO provide platforms where people connect, share experiences, and access financial education tailored to their needs. These aren't just support groups. They're powerful networks reshaping how financial knowledge spreads. The collective impact of these communities goes beyond individual success stories. When people collaborate financially, we see initiatives like the People's Business Enterprise National Council gaining momentum. Bank supports people-owned businesses through networking and improved access to capital, creating a powerful ecosystem of financial empowerment that lifts everyone involved. This isn't just about making money. It's about fundamentally changing what money means. Research clearly shows a strong connection between financial empowerment and improved life outcomes for people. Financial confidence correlates with better health, enhanced decision-making capabilities, and greater overall well-being. When people gain financial power, every aspect of their lives can transform. Think about how this applies to the cashless transition we're experiencing. Those who will thrive aren't necessarily those with the most technical knowledge or the biggest investment portfolios. The real dividing line will be between those who can adapt quickly, commit to continuous learning, and, this is crucial, build supportive communities rather than trying to navigate these changes alone. That's why experts emphasize that people's leadership in reshaping financial systems isn't just beneficial. It's essential for creating a more equitable financial landscape. The old systems were designed with limited perspectives, often excluding the needs and experiences of half the population. As we build new digital financial frameworks, people's voices ensure these systems work for everyone. Your role in this revolution doesn't require you to become a fintech founder or banking executive, though those are certainly options. It starts with recognizing that your financial journey connects to something larger. Each time you improve your financial literacy, try a new digital tool, or share your knowledge with another person, you're contributing to this transformation. What specific actions can you take? Join a People's Investment Club where you can learn alongside others. Participate in online communities focused on financial education. Consider mentoring younger people just starting their financial journeys. Share your experiences, both successes and challenges, to normalize financial conversations among people. Remember that financial empowerment isn't just about personal wealth. It's about creating options and possibilities in your life. When you understand how money works in the digital age, you gain the freedom to make choices aligned with your values, support causes you care about, and build the future you want to see. The habits that separate those who will thrive from those who will struggle in a cashless future aren't complicated, but they do require intention. Build your adaptability by regularly exploring new financial tools. Commit to learning one new financial concept each week. Most importantly, connect with others on similar journeys. Share resources, ask questions, and celebrate progress together. The mindset shift, from currency user to currency creator. There's a quiet revolution happening in the way we think about money, and it goes well beyond just using digital wallets or investing in cryptocurrency. What would change if you stopped seeing yourself as someone who just uses money and started seeing yourself as someone who creates financial value? This mindset shift might be the most powerful tool you haven't yet unlocked. The traditional view teaches us that money is something we earn, spend, save, and sometimes invest. But in today's rapidly evolving financial landscape, the line between those who use currency and those who create it is beginning to blur. Think about it. For generations, most people, especially people, were conditioned to be good managers of whatever money came their way. Be responsible, budget carefully, save diligently. While these are valuable skills, they position you as a passive participant in the financial system. The creator mindset flips this relationship entirely. The creator economy and digital finance are merging in ways that create entirely new possibilities. That report showing 55% of consumers now using fintech apps isn't just about convenience. It's about people shifting from being passive recipients of financial services to active participants in the economy. These platforms aren't just places to store your money. They're gateways to monetize your skills, ideas, and creativity. This shift requires challenging deeply ingrained beliefs about money and self-worth. Many people have been socialized to undervalue their contributions or to see money conversations as somehow impolite or uncomfortable. Psychological studies show that your mindset about money significantly influences your financial behavior. Those who view money as a tool for creating opportunities tend to engage in more proactive financial behaviors, like investing and entrepreneurship, compared to those who see money merely as a means of survival. So how do you begin this transformation? Start with practical exercises to identify your unique value creation potential. Try journaling about your skills and passions without considering their monetary value at first. What problems do you naturally solve for people? What knowledge do you have that others might find valuable? Set specific financial goals tied to those skills and explore platforms that allow for monetization, whether that's freelancing websites or content creation platforms. This creator mindset affects decision-making in all financial areas. When you see yourself as someone who generates value rather than just manages it, you approach investments differently, looking for opportunities to support and participate in growth rather than just preserve what you have. You view education as an investment in your value-creating capacity rather than just an expense. Even day-to-day spending decisions begin to shift as you consider how each purchase either enhances or diminishes your ability to create value. Consider the transformative stories of people who've made this shift. The entrepreneur who leveraged social media to build a thriving business selling handcrafted products. The financial advisor who created an educational platform that generates passive income while helping other people. These aren't outliers with special advantages. They simply made the fundamental shift from currency user to creator. What's particularly powerful is how this mindset connects to broader economic empowerment for people globally. Research shows that people who adopt a creator mindset are more likely to pursue leadership roles and advocate for financial inclusion. They contribute to systemic changes in the financial landscape, benefiting not just themselves, but creating a more inclusive economy for everyone. The merging of the creator economy and digital finance presents unprecedented possibilities for people. Technology now allows anyone to harness their skills to create wealth and influence economic systems. This positions people not just as participants, but as leaders in the financial revolution happening around us. What if this financial transformation isn't just a challenge to overcome, but your greatest opportunity? By seeing yourself as a creator rather than just a user of currency, You position yourself to thrive in a cashless future that rewards those who generate value, not just those who manage it well. Beyond survival, thriving in the new money landscape. Creating value instead of just managing it opens the door to something much bigger than financial survival. When we look at people who've thrived during major economic shifts throughout history, we see a pattern. They didn't just adapt to new systems, they found innovative ways to transform challenges into advantages. What if the end of cash, as we know it, represents the beginning of your greatest financial chapter? This transition we're experiencing isn't just about switching from physical currency to digital options. It's about completely reimagining your relationship with money. Think of it as financial reinvention rather than mere adaptation. The people who will truly thrive won't be the ones who simply learn to use new payment apps. They'll be the ones who see this moment as a chance to rebuild their entire financial foundation. The challenge: this requires letting go of financial habits and beliefs that might have served us well in the past, but no longer make sense. The idea that keeping money in cash is safe, or that financial education is optional. These are outdated patterns that can actually hold us back in this new landscape. Throughout history, people have demonstrated remarkable financial adaptability during periods of economic transition. During the Great Depression, many people developed innovative approaches to budgeting and resource management when they suddenly needed to support their families. This adaptability isn't just a historical footnote. It's a strength that people continue to demonstrate today, often without recognition. Research shows a powerful connection between financial empowerment and personal growth. When people gain true control over their finances, they experience higher levels of self-esteem and confidence. This isn't just about having enough money. It's about the sense of possibility that comes from knowing you can navigate financial challenges successfully. The journey toward financial empowerment doesn't require massive changes all at once. Small, consistent steps can create significant transformation over time. Setting aside even a tiny percentage of your income for investments can compound dramatically. Those minor adjustments to spending habits you've been considering? They might seem insignificant now, but they're the foundation of lasting financial stability. Your financial knowledge isn't just a personal asset. It can be a powerful tool for positive social change. When people become financially educated, we see increased participation in entrepreneurship and the workforce. These aren't just individual success stories. They become catalysts for economic growth in entire communities. The experts are clear. Thriving in a cashless economy requires a proactive approach to financial literacy and adaptability. Those who embrace digital tools and understand their financial options position themselves for success. This adaptability is especially important for people who often face unique barriers to financial resources. The key strategies: embracing technology and committing to continuous learning. Remember that this journey isn't about perfection, it's about progress. You don't need to become a financial expert overnight. Start with one small step this week. Maybe it's finally setting up that password manager, or spending 20 minutes learning about investment options, or having an honest conversation about money with someone you trust. Each small action builds confidence for the next one. The people who thrive in this new financial landscape will be the ones who see themselves as active creators of value rather than passive consumers of financial products. They'll be the ones who recognize that their unique perspectives are exactly what's needed to build more inclusive financial systems. They'll be the ones who understand that financial confidence creates freedom in all areas of life. The research is clear. Early fintech adopters position themselves better for economic ups and downs. As the financial landscape transforms, your engagement with these tools isn't just convenient. It's essential for your financial resilience. Remember that financial empowerment for people carries significance beyond personal benefit. As experts note, when people thrive, economies thrive. Your financial confidence contributes to creating a more equitable economic landscape for everyone. Ready to take that first step? Start with something manageable. Set up a high-yield savings account that works harder for your money. Explore budgeting apps that align with your needs. Even just learning the basics about cryptocurrencies can boost your financial literacy for our increasingly cashless world. The future of finance is being written right now.